Hello and welcome to Index Orbit. Today, we are performing a deep dive into the Nifty 50 market analysis and providing a comprehensive outlook for the next trading session. Our goals for this session are 1. To analyze current price action using smart money concepts. 2. To evaluate options open interest and how global cues are shaping our bias. And 3. To define actionable trading scenarios for the upcoming session. Before we start, if you find this analysis helpful, please like this video and subscribe to Index Orbit. For the best trading experience, live strategy building, and real-time data points, we recommend opening a Dhan trading account. You can use the referral code EJZZI96380 to get started with your Dhan Daymat account today. Let's start by looking at the market snapshot and major metrics. Nifty 50 spot is 24,211. Up 0.02%. Max pain is 24,200. Put-call ratio based on open interest is 1.62. At the money, implied volatility is 14.58. Let's start with a high-level view of where the market stands. The Nifty 50 closed the session on July 13th almost flat, up just 0.02%. However, this headline number is deceptive. While it looks calm, we saw a very narrow rally led by IT heavyweights, while sectors like FMCG, autos, and private banks faced broad-based selling. Externally, we have a risk-off signal with the Nasdaq dropping 1.26% and a significant spike in the US VIX of over 7%. Adding to this, crude oil surged 5% on headlines regarding a potential blockade in the Strait of Hormuz. Despite these global headwinds, local options positioning remains constructive. We have a heavy put wall at 24,050 acting as a floor, and a call wall at 24,500 capping the upside. This has effectively pinned the index near its max pain level of 24,200. Like and subscribe to Index Orbit. Open Dhan trading platform for best trading experience. Use referral code EJZZI96380 to open the account. Now, let's dive into the charts to understand the market structure through price action and smart money concepts, or SMC. Looking at the 15-minute futures chart, we see two distinct gap-up legs on the 10th and the 13th. The last down candle before these moves represents a bullish order block. This is the demand zone where smart money likely accumulated positions. Notice how this aligns with heavy put open interest, creating a strong confluence of support. However, these gaps left behind imbalances known as fair value gaps. These often act as magnets. We should expect price to be drawn back into these zones to fill the orders before a sustainable trend resumes. Observe the intraday wick spike toward 24,300. This was a classic liquidity sweep, a stop hunt that took out the stops of short sellers before immediately reversing. Today's session ended as an indecision candle just below that swept high. This suggests distribution and caution rather than a clean breakout. The higher-low structure is still intact above 23,880, but we must stay alert. To understand the strength of the move, we must look at the options market. Data points provide a clear picture of where traders are placing their bets. Looking at the open interest structure, the two walls are very well defined. First, the 24,050 level is our single largest concentration of puts. We saw heavy fresh put writing here today, making it our strongest near-term floor. This matches our technical order block perfectly. On the flip side, 24,500 carries the largest call concentration. Sellers are actively capping the upside here, showing resistance to any immediate move higher. The put-call ratio, or PCR, is currently elevated at 1.62. Usually, a high PCR is bullish, as put writers expect the floor to hold. But at these levels, it often signals base building rather than an aggressive breakout. Max pain sits at 24,200, while the spot price is at 24,211. This narrow gap is a sign of options-driven pinning, which kept the market contained today. Finally, the at-the-money implied volatility is at a relatively low 14.58. This tells us the options market is not pricing in a massive volatile swing for tomorrow, at least not yet. Like and subscribe to Index Orbit. Open Dhan trading platform for best trading experience and live strategy builder, and live data points. Use referral code EJZZI96380 to open the Dhan Demat account. Let's look under the hood at the sectoral breadth. Even though the index was green, the internal health of the market tells a different story. This heat map shows a very polarized market. As you can see, the gains are concentrated in just a few names. The rally was almost entirely driven by these IT heavyweights, likely due to earnings guidance. When a few stocks do the heavy lifting, we call this narrow breadth. Meanwhile, the vast majority of the Nifty 50, including banking, FMCG, and pharma, closed in the red. This is a major caution flag. A healthy market moves up together. When the generals lead but the soldiers retreat, the rally is fragile. You need to be very selective with your stock picks right now, as the headline index number is hiding this underlying weakness. Take a moment to consider, if the IT sector cools down tomorrow, is there another sector ready to take the lead? Based on today's data, the answer seems to be no. Like and subscribe to Index Orbit, Open Dhan trading platform for best trading experience and live strategy builder. Use referral code EJZZI96380 to open the Dhan Demat account. Global cues are the wild card for the next session. While local positioning is supportive, the international environment has shifted toward a risk-off stance. Nasdaq fell 1.26%. S&P 500 dipped 0.31%. The US VIX spiked to 16.14, and Brent crude is up 5% to $80. The biggest concern is the sharp drop in the Nasdaq and the spike in the US VIX. Indian markets typically gap react to this kind of volatility in US tech. Geopolitics are also at play. Reports of a reinstated blockade against Iran have pushed Brent crude up to $80 per barrel. As an oil importing economy, higher oil prices are a direct headwind for India's current account and historically negative for Nifty sentiment. However, there is a partial offset. News that the Strait of Hormuz will remain open, along with reports of Dubai fast-tracking a bypass port, reduces the tail risk of a complete shipping disruption. The net red for tomorrow? Global cues skew mildly negative. We should expect a cautious or even a gap-down open, despite the strong local support at 24,050. Like and subscribe to Index Orbit, Open Dhan trading platform for the best trading experience. Use referral code EJZZI96380 to open your account. Based on all the data we've gathered, let's build our scenario playbook for tomorrow. We have 3 distinct paths the market might take. Scenario A is our most likely outcome given the global cues. In this path, Nifty opens weak and slides toward the confluence zone between 24,120 and 4,050. This is where our put wall and bullish order blocks sit. If 24,050 holds, look for a reaction bounce back toward 24,200. If you are holding long positions, this is your key decision zone. If it breaks with high volume, the next stop is the structural support near 23,880. Scenario B assumes the low implied volatility and max pain pinning continue. We could see choppy, two-way trade between the two major OI walls. This environment favors range-oriented strategies like iron condors. But remember, a decisive close outside this range ends the thesis. Scenario C requires IT strength to continue or a sudden de-escalation in oil prices. A hold above today's swept high of $24,300 opens the door to the $24,500 call wall. Because $24,300 was already rejected once today, a break above it must be confirmed by a retest holding as support to avoid another liquidity trap. Like and subscribe to Index Orbit, Open Dhan trading platform for best trading experience. Use referral code EJZZI96380 to open your Demat account. To wrap things up, the weight of evidence leans toward a cautious to lower opening bias. The global combination of a soft U.S. tech close, a VIX spike, and oil supply risks suggests a test of our support levels. Let's look at our final summary checklist. The level that matters most tomorrow is 24,050. This is where the technical order block meets the heavy options concentration. If this floor remains firm, the structural uptrend stays intact. If not, we look to the deeper gaps below. Remember that because the current rally is so narrow and IT-driven, your choice of individual stocks will likely matter more than the index movement itself. Please note that this analysis is for educational purposes regarding market structure and is not investment advice. Always verify current prices and news before making any trading decisions, and consider consulting a CB-registered financial advisor. For a seamless trading experience with live data and advanced strategy builders, open your Dhan account today. Use the referral code EJZZI96380 to get started. Thank you for watching. If you found this breakdown valuable, don't forget to like this video and subscribe to Index Orbit for your daily market insights. We'll see you in the next session.